IHS MarkIt has put out its latest oil sands supply forecast, and it's very interesting in the post-COVID world. And I'm going to talk to Kevin Birn, who's the economist for Oil Sands Dialogue that looks after that forecast, and see how much it's changed over the last few years and look out into the future a little bit. So welcome to the interview, Kevin.
Pleasure, Markham.
Now, look, you're forecasting that by 2030, that supply, basically oil sands production, will increase by 650,000 barrels a day and be 3.6 million barrels by the end of the decade. It's down a little bit from 2020. And what is it that you think, what are the drivers of that more modest growth?
Well, I think, if you look back the last couple of years, we have been pulling down our production expectations for 2030 from the oil sands. We've been releasing, making public our outlook, a 10-year outlook for about since 2015. And so I think in this case, what you're seeing is ongoing delays to critical infrastructure and price volatility, not only associated with that, but global price volatility, such as COVID-19 impacts that we saw last year as well, reducing the amount of capital available to the oil sands producers, but also delaying the timing of when they could possibly bring online new developments. At the same time, we see an acceleration and a shifting in pressures, both from the financial community to a large degree, asking for improvements in cash flow and greater returns, but also asking for prioritization of decarbonization, which will require capital as well.
Right. Now, one of the things I'm very curious about is this expansion of the oil sands production tied to overall increase in the global supply of oil, like from 100 million barrels a day to 103 or 106 or something? Or is this supply going to eat into the other producers of heavy crude oil like Venezuela and Mexico, so that Canada, Alberta basically takes a bigger share of the 10 million barrels a day of the heavy crude market?
I think it's probably to the latter. What we've seen Canadian oil sands production, the heavy barrels coming out of it does produce light barrels as well, or lighter barrels, has been going to off displace reductions in the availability of heavy sour crude oil elsewhere in the world. And it's been going to fill basically the processing capacity in the Gulf Coast that has been seeking out those heavy barrels. We continue to expect the majority of this to seek out existing infrastructure to process heavy crude. There's simply less incentive globally in making large-scale expansions into heavy processing, basically because of the abundance and growth of light crude oil, which resulted in changed the differential equation for the attractiveness of processing incremental heavy crude.
Another point that you made, and I find this, it really caught my eye, and one of the constraints or the reasons for the lower forecast is rising energy transition pressures. Now, I've made the argument that the 2020s are going to be the really disruptive decade in this energy transition. And is that the pressure that the oil sands producers are feeling?
I think so. We did note it. It's for us, we read it kind of doubly. We're seeing investors discount future production and future reserves more heavily in anticipation that they expect global demand will eventually roll over. Now, there's varying degrees to when you expect that to happen, but from the investment perspective, generally, we're seeing a general discounting of reserves and future production potential. So the interest in incremental growth is being shifted towards cash flow. And at the same time, I think we also see recognition of potential for greater expenditures in decarbonization, which again would redirect some of that free cash flow to other priorities. So these things mean, in our view, there potentially less money for the further developments that we had to anticipate in the past, and that's chipping away at the forecast we had. If you look at the release itself, we do provide some guidance around where we see the growth coming from, and you can see that very clearly is coming out of what we call step out or incremental projects. And as a result, the forecast is increasingly reliant or underpinned by the utilization, ramp up, and optimization of the existing base of assets.
Now, about 3 weeks ago, Suncor released its investor presentation. It had all sorts of very insightful charts. And one of them showed that the break even for Suncor was going to fall from an average of $35 US West Texas Intermediate to 27 by 2025. That's a very significant fall. And it seems like all of the producers are driving down their break evens. And I would assume that that played a role in your forecast. I mean, it makes them more competitive against some of these other global crudes.
I'd say, well, it's which came, let me put it this way. When we see the existing infrastructure and we think it, the oil sands has been running a little as a whole, not into, the individual assets, and everybody's a little bit different. But since late 2018, when we had the differential blowout, then we had the imposition of the Alberta curtailment, and then we had COVID, that's caused the producers to run a lot of their facilities suboptimally and to suppress the ultimate potential that already exists in the market. We expect they will now run that up. And as you do, you find opportunities to tweak the system and maximize the output. When, a lot of those cost structures aren't necessarily as flexible as you think when you run suboptimally. So your per unit cost goes up. So as they ramp up these facilities to their nameplate and even optimize some of them as well, that has the potential to drive down the per unit cost or the operating cost you talked about. And so we expect that to continue over the next couple of years as they run that up. There is a break point in our outlook if you do look at it, and that's when it pivots from the ramp up of existing and the potential for new to come in. And that's how I would hope people look at our outlook. Certainly it's our expectation of growth at this point, but it's really meant to inform people's understanding about the factors at play in the oil sands and where that potential growth could come from, and you to make your own choices about what you think may or may not happen. So I would encourage people to look at that one figure. It's very instructive in that sense, and think about that ramp up on utilization of existing has the potential to drive down operating costs as it does that.
Final question, Kevin. We're going to have Trans Mountain expansion in service, it looks like, next year. And that raises the question of Asian markets. And does that play a role at all, or is there not likely to be a lot of incremental market share to be gained in Asia?
Well, we've always viewed, Trans Mountain Pipeline as an opportunity to access tidewater, and the producer would be able to attain global prices from that once it's on the tidewater, and it would be free to flow to that highest price point globally. We do see opportunities in heavy processing capacity in Asia, in multiple Asian locations, India and China and elsewhere, as well as there's opportunities in California that have heavier, more complex facilities, and even potential for some of it to work its way back around to the Gulf Coast to help balance that Gulf Coast system. So it's really, in our view, it has the potential to go to a lot of different markets. And I think it's important to understand that there are a lot of different refineries with different ability to process a barrel. Refineries don't process one barrel of oil or one type of crude oil. They tend to process a wide range of slates, and those slates will move around depending on the products they are trying to make for different times of the year. And so I think it's best way to think about it. It would blend into a broader system in the Pacific Basin, and including potentially make its way back to the United States in certain ways as well.
Kevin, thank you very much for this. Really appreciate your insights.
Thanks, Markham.